ಎಲ್ಲರಿಗೂ ನಮಸ್ಕಾರ. Myself Murli Mohan V, Assistant Professor of Commerce, Government First Grade College, Kumuta. Today, I am going to share a video on the subject Financial Accounting Part 1 on the topic Higher Aspect of Partnership Accounts 2, a simple sale of a firm to a company. Sale of a firm to a company, we can call it as conversion of firm to a limited company. Before we get into the details of how this conversion process is going to be happen, you should know what is business. We're all going to undertake business in different ways. I hope you all knows that business it is an economic activity concerned with production and distribution of goods and services with the intention of to earn profits. So the business the business can be undertaken in the form of sole trading concern, partnership, company. This is all the ways the individuals or group of peoples they can undertake business. Sole trading concern means business activity undertaken by single person. The entire business process it is run and managed by individual. Whenever the individual person running the business, the entire capital required for the business, whatever the profit and losses is arised in the business, it has to be paid by the individual persons. So due to scope for expansion and diversification, the sole trading concern it may be converted into partnership. Partnership refers to the business undertaken by two or more persons as well as agree to share the profit and losses. So as I said, business it may be a sole trading and partnership. So because of huge opportunities and limitations of the sole trading concerns and partnership, the company's activity start emerging. So before getting to that company aspects, we should know what are all the limitations of include in the sole trading and partnership. The major limitations in the both the sole trading and partnership it is in terms of manpower. We're talking about manpower. As I said, sole trading concern is one person, partnership is two or more person. Due to this, both the type of business having problem with men, human resource. Not only with men aspect, it also having lacking of resource in terms of capital also, as well as when there is a lacking of human resource, it leads to a lack of skill and knowledge which is required for to undertake business activity. Due to these limitations, because of the limitations, the same while the business having more opportunities in the form of expansion and diversification. Expansion of business refers to a starting of one more additional branches in one another places. For example, if we are running a business in Uttarakhand district, we want to start in another district. Suppose we're going to start establish one more branch, say example of Dharwad, Belagavi, Raichuru. This is called as expansion. Starting of one more branch other than the existing place. It is called as expansion. Diversification means get into the field of new field. Example of Ambani. Take example of Ambani. Ambani is dealing with vegetables, petroleum, telecom. Now is getting to getting to air force also. So diversification means get into the new field. emerging business. So due to these limitations and opportunities, there is a need for conversion of this partnership firm into a company. So conversion means shifting the status of the firm's business. So here, when partnership firm is converted into a joint stock company, it is called as conversion. When during sale of a partnership firm, the new company is formed. It is called as conversions. When the partnership is converting into a company, all the partners of the partnership firms are becoming shareholders of the new company. So let me move on to next. What are all the main objectives of a conversion of firm to a joint stock company? First objectives, it is to enjoy limited liability. See, in sole trading and partnership, the liabilities of the members, it is unlimited because shortage of manpower. What are all the liabilities is belongs to the business, it has to be paid by the whatever the members is included in the business. If this business converted into a joint stock company, the liabilities for the members is compared to partnership, it is very less because company it is huge in number, more number of people working in the company, more number of members. Because of this, whatever loss of the business, a liability obligation of the company belongs to members is very less. Second objective, to continue a business for a long time. Long time the sense, see in sole trading concern and partnership, if any members becoming insolvent or death, then the business starts to be dissolved. Whereas if this company, the business firm, is called as company, even though any members called as insolvency or death are not able to dissolve, it can be run for a longer run. Next objective is the expansion of business. Because of more number of people working in the company, they have more skills, knowledge, capital. They can expand their business however they want across the globe. That is third objective. Next objective is to easily transfer the shares from one to another. See, in partnership, whenever members choose to transfer, they're not able to transfer because they have to take consent of the partners. If it is the company, they are called as shareholders of the company. Their rights, they whenever they want to fit transfer, they can easily transfer. To avoid this benefits, the partnership firm, it has to be converted in the company. Last objective is to earn more profits. See, in partnership and sole trading, whenever the business earn profits, for that year only they is to get return. But in the case of company, even though the company is running under the loss, there is a possibility of accumulating the dividend. So every year, the shareholders of the company, they are entitled to fixed rate of dividend from the company. So these are all the objectives of the conversion of a firm to a joint stock company. Let me see next, during conversion of this firm, what are all the accounting procedures to be followed? The first step during conversion is open a realization account. Realization account refers to the during sale of a partnership firm, the partners they have to sell their assets, they have to transfer their liabilities to the purchasing company. During selling of the partnership firm, whether they are getting profit or loss, they have to prepare realization account. Again, they have to calculate purchase consideration. Purchase consideration refers to the Price paid by the purchasing company to the partner. So during sale of partnership firm, the company willing to purchase a partnership business, the purchaser has to give some agreed price for the partners. So once it is calculated, purchase consideration should be credited to realization accounts and debited to purchasing company accounts. So during closing of realization account, if credit side is more than the debit side, so we're going to identify profit on realization. If it is debit side is more than credit side, realization loss. So after this, we have to transfer whether it is profit on realization or loss. Apart from this, reserves and surpluses, we have to transfer to the partner's capital account based on profit sharing ratio. As well as we have to receive whatever purchase price it is to be calculated, that price we have to receive from the purchasing company. The purchase consideration, it can be made by the form of shares, debentures, as well as cash also. So we'll see what are all the accounting entries it has to be recorded. There are 19 journal entries has to be passed during conversion of firm to a company. First entry is for transferring different assets to realization account. The entry will be realization account data to sundry's asset accounts. Second entry for transferring different liabilities to the realization account. Entry will be liabilities account data to realization account. For purchase consideration due, purchasing company's account data to realization accounts. For assets taken over by the partners. So entry will be partners capital account data to realization account. For realization of assets not taken over by the company, bank account data to realization account. If any recording of any unrecorded assets, assets account data to partners capital account. Next, for realization of unrecorded assets, so entry will be bank account data to asset account. For payment of liabilities not taken over by the company, the entry will be realization account data to bank account. For recording unrecorded liabilities, partners capital account data to liabilities account. For payment of unrecorded liabilities, liabilities account data to bank account. For liabilities are paid by the partners, entry will be realization account data to partners capital account. For realization expenses, realization account data to bank account. For profit on realization, so realization account data to partners capital accounts. Whatever profit on realization, this profit it has to be distributed to the partners based on profit sharing ratio. If it is loss on realization, the entry will become opposite. Partners capital account data to realization account. For accumulated profits and reserve, reserves account data to profit and loss account data to partners capital accounts. For accumulated losses, partners capital account data to profit and loss accounts. For transferring partners current accounts to capital account, partners current account data to partners capital account. For settlement of purchase consideration by the new company, The entries will be shares in new company account debtor, debentures in new company's account debtor, cash account debtor to purchasing company's account. Last entry it is partners capital account debtor to shares in new company accounts, debentures in new company account debtor to cash accounts. Next class we'll see about what are all the different ledger account we have to be passed. Thank you.